Hi, everybody. Welcome to your Money Map, sponsored by the Alliance for Lifetime Income. I'm Jean Chatzky. I'm very glad to have you with us today as we talk about a very important topic that is at the root of the mission of the Alliance for Lifetime Income, and that's protected income. Retirement should be about financial confidence, not uncertainty, but with longer lifespans, shifting retirement landscapes, and an economy that's been in flux. How can you be sure that your savings will last? For many people, protected income in the form of an annuity offers a powerful solution, providing guaranteed lifetime income that protects you from outliving your money. And yet, over half of all Americans fully admit they don't understand how annuities work or how they can secure their financial futures. Today, we are diving deep into the topic of annuities, everything from what they are to who they're right for, to the different types, to some of the biggest myths surrounding them. Joining me are two pros when it comes to retirement planning, protected income, and annuities. First up, Michael Finke. He is a fellow with ALI's Retirement Income Institute, as well as a professor of wealth management at the American College of Financial Services. He's a nationally known researcher in the areas of retirement income planning, spending, life satisfaction, and cognitive aging. And he was named one of the 25 most influential people in the field of investment advising by Investment Advisor magazine, not once, but twice. Also joining us today is Tamiko Toland, an Alliance Education Fellow, as well as an award-winning industry expert on annuities and retirement income, so much so that she has earned the nickname the Annuity Yoda. We love her for that. Tamiko has a consulting practice and is also the founder of the 401k and co-founder of Income Path. Michael, Tamiko, welcome to the show.
Great to be here with you.
So let's start with the basics. And Michael, I will kick it off with you. What is protected income, and what types of protected income are available to people?
Yeah, so in my mind, protected income is income that you know is going to last a lifetime. So there's different types of wealth. You can invest in stocks or bonds, but when you pull the money out of the stock and bond account, then there's no guarantee. If the money runs out, there's going to be someone or some entity that's going to continue providing that income stream. So protected income is income that it's essentially like a paycheck. It's income that's going to come in on a regular basis, and it's going to continue as long as I'm alive. So the most popular form of protected income is Social Security. Social Security is a form of annuity. It is a lifetime income. It is adjusted for inflation. It's provided by the government, but it's an annuity. So in general, people like Social Security. So they like this whole idea of protected income. Pensions are also a form of protected income, and annuities can provide protected income through lifetime income guarantees. So essentially, as long as you're alive, they're going to continue making those payments.
So you said Social Security is a form, a type of an annuity. Annuities are a big category. Tamiko, what are they, and how do they work?
Sure. So I think one of the confusing things is that we use one term, annuity, to talk really about a lot of different types of products. And the one thing they all have in common is that they can provide that guaranteed income for life. But they're also used for saving for retirement. And so they can do that in a more protected format that's safer, that you're not going to lose your money, and others where you may have more involvement in equity markets. So a lot of what is the right annuity really depends on the individual situation. But in their essence, they all have the ability to give that kind of income.
You said the word safer. I think that is a word that is incredibly appealing to people, at least over the last couple of weeks. We've seen the impact that policy changes can have on the markets, on our investments, on our retirements. A lot of people are feeling really demoralized. Are annuities a good investment during this sort of economic volatility? Can you tell us why or why not? And Tamiko, let me stay with you.
Great. Yeah, no, absolutely. I think that anybody who is concerned about the risk of markets, who wants a place where their money is going to be growing and potentially earning that or providing them that income when they're ready to retire, it's like a bond portfolio, but there's no chance of it going down. So it's not like a bond fund. So it's just really, I think of it as part of that component of your investments that anybody would normally have while preparing for retirement or being in retirement.
When we think about annuities and how they fit into a person's retirement plan, one of the first things, Michael, I've heard you tell people is you got to look at what you're going to need. How much income are you actually going to require to live on? What does that process look like? How should it work?
So I like using a goal-based process. So what do I want to achieve with my nest egg? A lot of people never really think about this. So I have all the wealth that I've saved up for retirement. I've got investments. I've got my home. What do I want to do with that in retirement? Do I want to pass on a certain percentage of that after I'm gone? Do I want to carve out a certain portion and use it to fund my lifestyle expenses? I think that's a conversation many people never have. So let's say step one is to figure out of my wealth, how much do I actually want to spend? And then figure out, all right, how much variability am I willing to accept with that spending? And I think that's something a lot of people don't really think about. When they think about risk, they think about, well, what are the chances my investments are going to go down? But when we're thinking about lifestyle, what risk means is the possibility that I might have to cut back on my spending. If you look at how retirees spend money, about 65% of expenses for someone that made over $100,000 during their working life are on fixed expenses. So, what are fixed expenses? So, things like healthcare expenses or property taxes. These are the paying insurance bills. These are the kind of basic expenses that are a big part of the retirement lifestyle. And when you're funding those expenses, you really can't cut back on them. So you have to put together some kind of a plan that's going to be able to provide you with that stability of basic income. Now, you also have variable expenses and you can choose what you want to do with those. But the way I think about annuities is Social Security is going to cover a chunk of those basic expenses. And I want to be able to cover the rest of them either with, as Tamiko mentioned, bond-like investments that are not very volatile or with an annuity. The advantage of the annuity is since I don't know how long I'm going to live, I can take that risk and transfer it to an institution like an insurance company. And that actually allows me to spend more every year, or it allows me to take a smaller percentage of my portfolio and use it to fund that basic spending goal.
Before we come off of that point, just talk about the difference between using a bond or a bond portfolio to meet that need and using an annuity, because I think there's a nuance there that's important.
Yeah. So let's say that your goal is to fund $2,000 a month from, let's say, a $500,000 bond portfolio. So you put it into, let's say, a bond mutual fund or an ETF. But that bond mutual fund or ETF is going to rise or fall over time, depending on interest rates and a few other factors. And it may be that you can fund $2,000 a month to the age of 90 before running out of money, maybe to the age of 95. It's all dependent on what the market does. With the annuity, you can essentially lock in that $2,000 per month with a lump sum of money. And that lump sum of money is actually going to be lower than the amount that you would have to invest in a bond fund in order to fund spending to an age at which you feel comfortable about avoiding the risk of running out of savings. So because bond investments are volatile, they go up and down, you don't know how much income you can generate from that bond investment over time if you want to create a paycheck from those less volatile investments.
So what you're talking about there essentially is this concept of pooled risk, which we do all the time with our auto insurance and our homeowners insurance and even our life insurance. We often just don't think about it in this way. And that is because I think insurance products can be complicated, and annuities are a word that a lot of people are just not familiar with. Tamiko, how does somebody know if an annuity is a good option for them? And then can you, in the plainest possible language, take us through the different types of annuities so as somebody goes shopping, they know what to pay attention to?
Sure. So, annuities can do different things either before you retire or after you retire. And that's something to bear in mind, that sometimes people actually just use them as a safe place to grow their money. And so, this like a CD, like a bank CD. Um, but you don't pay taxes on it actually while it's sitting in the annuity. So that's one thing to consider with the most basic kind of annuity. And so I think one key, though, from the standpoint of generating income is, are you going to feel better by having this income guarantee? And sometimes it's something you can use in the future. And sometimes you're deciding, okay, I'm going to start this right now. So thinking about the kinds of risk you are trying to get rid of, right? These are the important things to consider. And there's so many different kinds of annuities that really address different needs. So the two basic large categories are ones where you can't lose any money. So fixed annuities, that includes fixed indexed annuities. And you can also lump in, anything that pays that regular paycheck throughout retirement. And then also there are more variable annuities where there's a possibility of losing money. And the things you can attach guarantees onto that as well. So this is where it gets a little bit more complicated. But if you're going to be doing something where it's possible to lose money, I think the assumption is that you're willing to tolerate a little bit of that risk, even if there's some kind of guarantee attached to that. So that's at the high level how I like to think about these products.
To get a little more granular, we actually have a couple of graphics, because there's this perception, as I said, that annuities are complex, they're hard to explain, they're difficult to understand. According to research, 64% of consumers say annuities are the most difficult financial product to understand, and that perception does not seem to exist for products like mutual funds or bonds or ETFs, even though those products as well can be really complex too. The Alliance for Lifetime Income has done now years of research, and it focuses on two main problems. The first problem is the different ways that annuity companies describe the types of annuities that they provide. So Tamiko, you talked around this, but looking at this slide, can you go into a little bit more detail?
Sure. It's funny because a number of these different terms are actually referring to the same basic product. And so that's why I can take my sort of fixed and variable categories and lump everything into one of those two different buckets. But I think the key is to think, okay, is this an investment where I cannot lose money? So some form of fixed annuity. And do I want to take income now? Do I want to take income later? And so that's what some of these terms refer to. And there's one of the terms that's on there that's a little antiquated. So, I think it can be so confusing if you start looking at all the different words, all the different products. And I would hate for someone to think that they need to understand every little thought conversation bubble here on this slide in order to feel confident in using these products, because you're hopefully going to get some kind of guidance from somebody who can help you understand how this annuity that you're considering works and how it helps you achieve your own goals, whether those are before you retire or after you retire.
Right. And the sea of language, the word salad, gets even more complicated on the next slide, which it basically is all the different features that are used to describe the words that are used to describe and sell annuities. Michael, we've talked about this before. I mean, what do you think we do about this word salad?
Yeah, when I look at the word salad, I think there's a phenomenon going on, which is that consumers in many ways are driving some of this complexity. There is a very simple form of annuity. You can buy, say, a deferred income annuity that begins a few years from today, or you can buy a single premium immediate annuity that is very simple, where you're just giving up, say, a lump sum of money, $300,000, and you're getting a guarantee of, say, $20,000 a year. And generally, they're fairly priced and they're very simple, and nobody buys them. Why don't they buy them? Because they have to give up a bunch of money, and oftentimes people don't like the idea of having to give up a bunch of money today for a promise of income in the future. Psychologically, that's a little bit difficult to get over. So what ends up happening is that insurance companies design annuities that provide, say, lifetime income, but they have to design them in a way that the consumer does not have to give up all this money. In other words, it retains a certain amount of liquidity. Um, and then you get a guaranteed amount of income that you can withdraw from that lump sum of money, say, every month or every year. It acts very similar to that very simple type of annuity, but it is created to provide the consumer with a product that is more, I think, psychologically palatable. And so you end up with a lot of complexity that isn't actually so much driven by insurance companies as it is by the market. The market wants some of these guarantees, and they want it to be in a somewhat more complex format, because anybody can go out and buy a very simple income annuity, but not a lot of people do. So the companies have to respond and then design products that people will actually buy.
So, Tamiko, if somebody is going and sitting down with a financial professional and they're interested in this concept of lifetime income, protected income, guaranteed income, annuities, whatever we're calling it, what questions should I be asking my financial professional in order to get the right product for me?
I mean, I would really start with, do you recommend annuities to your clients? And what kinds of annuities do you recommend? Because not all advisors really use annuities a lot. And so you really want somebody who's pretty fluent in this, because you don't want to become fluent in it. And to me, that's the starting point. As well as that, let's say somebody does work with annuities. Questions to ask are, how do you see achieving this goal of mine? Like, this is my objective. And I like to think of annuities as something that are planned with. Like, it has to be not just this one thing in isolation, but it's really part of a cohesive plan. And there are a lot of different ways of accomplishing that. And so understanding the plan and making sure that that makes sense to you is really important.
Why are there some advisors who don't work with annuities? I mean, if these are products that, as Michael says, people like, they like the idea of Social Security, they like the idea of guaranteed income, why do we have trouble in that vein?
Gene, this is a very good question, because if you look at how science views annuities, how economists view annuities, we think it's a puzzle that more retirees don't buy them. In fact, it has a name. It's called the annuity puzzle. And anybody who wants to read about the annuity puzzle can read a wonderful article in the New York Times titled The Annuity Puzzle by Richard Thaler, a Nobel Prize winning economist. It basically explains how economists think about the value of annuities. Now, a lot of advisors traditionally were not compensated when they recommended an annuity, when it may have taken money off of the balance sheet of their clients that they get paid from. So they get these hardened opinions like, I hate annuities, or I would never recommend an annuity, when the reality is that most of us who do research in this field plan on buying an annuity when we retire. In fact, I don't know if I've talked to anybody who is a retirement researcher that's an economist who doesn't plan on buying some form of annuity when they reach retirement. So I think traditionally what has happened is the compensation has shifted people's attitudes. If they don't get paid for it, oftentimes they don't like them, or they don't they don't feel like they want to recommend it to a client. But I think what the reality is, that what's happening is opinions about these products are softening. People are becoming more knowledgeable, And advisors, even the ones that don't get paid for recommending them, I know many advisors that will still recommend them if the goal is to create a stable income in retirement. And a lot of retirees just happen to have that goal. So annuities make sense for a lot of retirees. In fact, it's hard to imagine that no amount of annuity income would make sense for most retirees who have accumulated a substantial amount of wealth. And there's also the issue that many of us just want to automate it. We don't have to worry about it. We just want to set it and forget it and say, I'm going to get a paycheck. I mean, that's what I want in my own retirement. I don't know if you feel the same way.
It's exactly what I want. I want to know that I'm going to get a paycheck for as long as I live. I certainly wouldn't annuitize everything because, of course, you need some money in the market working for you to keep growing but yes, the interesting thing, though, I think about the annuity puzzle is that we're not just talking about one puzzle. Richard Thaler was talking about why don't more people buy them. But in fact, you and your colleague, David Blanchett, who is also a fellow with the Alliance for Lifetime Income, have done a series of studies now where you've looked at the spending puzzle and the fact that people spend income and assets very, very differently. You released a study a couple of years ago. You released a new study just in the last week. Tell us about this research.
Well, imagine that you have two retirees. One, let's say, got a pension. They work for a company that gave them $2,500 a month in a pension. And then you have another retiree who didn't have a pension but saved in their defined contribution plan. And at retirement, they have $500,000 in their IRA. So they could go right now and buy an annuity that gave them $2,500 a month. So what we do is we compare the one who has $500,000 in their IRA to the one that has $2,500 a month and $500,000 less in their IRA. And we ask which one spends more. And not surprisingly, the one with lifetime income spends more in retirement. But actually, what we found was they spend so much more that it's a real mystery. There has to be some sort of behavioral phenomenon going on. And what we think is that people just don't feel comfortable spending money out of savings. We all know of examples like this. I think I'm the same way. If I have a certain amount of money in my savings account and it gets below that amount, I feel a certain amount of emotion. I feel like I've lost something. And I think most retirees behave that way. And it's sure, and a way of understanding that I think is required minimum distributions. People see the required minimum distribution payment that they get from their investment company as, oh, I can spend this money this year. So maybe I got a $25,000 RMD check this year, and people go out and spend it. And we actually found that in the research, that when you get your RMD, people do tend to spend more money from their IRAs after the age of 73. Which doesn't make any sense because you could have spent that money before the age of 73. You could have just withdrawn the money from your IRA yourself and lived better. But essentially what's happening is we're allowing the government to decide how much we should spend from our IRA savings as opposed to taking control of it and doing it ourselves. So I
I
think we
think
could all spend more if we took part of our savings and turned it into a lifetime income.
Yeah. Yeah, I think that's very true. It's a version of the big dollar, small dollar problem, right? There's been research that looks at the cash that people carry around in their wallet in the days that people actually carried cash in their wallet and found that if you are carrying 20, you're going to have a very, very easy time spending those. But if you're carrying 50s and hundreds, it's much, much tougher to break. Psychologically, big sums and savings are big sums are tougher to wade into. Tamiko, one of the big factors I think that makes protected income attractive to people is just this longevity factor, the fact that we are living longer, that if we hit 65, chances are pretty good we're going to make it to 85, and that half of all the people who hit 65 are going to make it past 85, and that women in particular are going to outlive our partners by a good 6 years. How do you think about annuities as they relate to longevity and particularly for women?
Well, Michael mentioned it earlier that this is a risk that you can give to the insurance company. And this is the only way to do that is through an annuity and through this kind of guarantee. And from that perspective, it's really invaluable because there are all these variables in retirement. And if you think about before retirement and after retirement and the amount of change that you're going to be exposed to, there's actually more stuff that happens after you retire. Like chances are a spouse is going to die. Chances are with the length of time you're going to be in retirement, you're going to be going through some market disruption, maybe more than one, right? And so you think about all this uncertainty that you're facing. Well, one of those uncertainties is how long you're going to live. So it really makes a lot of sense to take that one off the table. So that's how I think about it. And, particularly for women, obviously in general, we live longer than men. And often women don't accumulate the same wealth that men do. So it's a very efficient way of making sure that you have income for the rest of your life and really reduce a worry that you otherwise might have. And so that's something I like to think about as well. It's like we don't want to be sitting around in retirement just being concerned that something bad is going to happen. We want to be able to enjoy that time. If this is supposed to be our reward for work, then we have to make it rewarding by being worried less.
One of the things people are especially worried about these days is Social Security. The president has said he won't touch it, but there have been already DOGE-driven cuts to the Social Security Administration staff and services. That has a lot of people on edge. Do you think, Michael, that people should be concerned about the future of the program? And if they are concerned, what are the things that we can control, that we can put in place to, if not shore up the economy of the United States, at least shore up our own personal economies?
That is such a great question. First of all, let's talk about how Social Security works. Um, the government taxes people who are working right now. So you have to pay this employer tax, this payroll tax, and the money goes into the Social Security system. And then the Social Security system divvies out checks to current retirees. And that's why it never is going to go bankrupt. As long as there are people working and money flowing into the Social Security system, you're going to get a paycheck. Now, the question becomes, all right, how much are you going to get compared to what you've been promised? And in the worst case scenario is that you get maybe a little bit less than 80% of what you've been promised. But this is very unlikely to happen because if Social Security recipients get their paychecks cut by 20%, no politician is ever going to get reelected. So I think you can count on some sort of a solution that is going to give people about what they expect to get. And it may mean that we have to increase taxes. It may mean that we have to make some small tweaks in the amount of benefits that people receive. And it may mean that the government's just going to borrow even more money. But generally speaking, you can expect to get those Social Security benefits. It's not going to go away. Even for younger people, there's still going to be a Social Security system when you retire. And one of the aspects of Social Security that I think a lot of people get wrong is that they don't wait to claim their Social Security benefit. And for those of us who study retirement income, it's kind of a no-brainer that we're all going to be waiting till 70 in order to claim our benefits, because we can get a lot more in Social Security income. And Social Security income is great. It's inflation protected. It goes up over time. It lasts as long as we're alive. And as long as the federal government is still printing money, we're going to be able to get our paychecks. So Social Security is one of those things where it's an essential part of retirement income planning. And I think most people should think about it as a source of their funding their inflexible expenses in retirement. And they need to be careful about when they claim in order to maximize those benefits.
Yeah, absolutely. I mean, if you need to put food on the table and you're truly struggling, of course you claim your benefits. But if you have a choice of other sources of income to pull from to tide you over to claiming at least at full retirement age and preferably at age 70, that 8% bump in benefits every single year is such an incredible guaranteed return. I want to, in the time that we have left, talk just a bit about annuities in retirement plans. The Secure Act 1 and the Secure Act 2, they made it easier for Americans to gain access to annuities in their 401ks, at least in theory. Many employers have yet to roll out protected income solutions within their plans. We know that many of them are working on it, but it just hasn't exactly materialized yet. Tamiko, what's happening behind the curtain? And do you think that we'll see these solutions anytime soon?
Yeah, so we are starting to see an increase in availability, but it's not going to be like all of a sudden everybody gets access overnight. The thing is that your employer has to decide to add it to the plan, and they have to feel comfortable doing it. And let's remember that employers are fiduciaries. So this is a very serious decision for them to make. One of the things that I find really heartening is the fact that a lot of folks are really looking at this as a, a component of the default. So, the default is if you are in your plan and you don't choose an investment, your employer picks something for your money to go into. And this has been a tremendous focus for retirement security, increasing retirement security, making sure that, like right now, mostly you're in some kind of target date fund. So incorporating annuities into the target date funds, not where you have to get the income, but where you have the option of getting that income, that can be a real game changer. And that's really the direction that the industry is moving towards. So I'm really looking forward to the expansion of options as everybody gets comfortable with something that they're also not necessarily completely familiar with. And these are very new products. They're very different from what's available in the retail market.
As I think about annuities in retirement plans, I think a little bit about disability insurance, right? If you're offered disability insurance via your employer, generally you want to take it because it's the cheapest way of getting whatever you're going to need. But it also typically is not going to be enough to get you as much disability insurance that you should probably have, particularly if you're a single person or have another real need for that insurance. Do you expect this to roll out the same way, that some of the annuitization will happen from within the plan, but some of it will still need to be done by individuals on their own, Tamiko?
So I think this is one of those, your results may vary situations because it depends. Like, if you've been rolling your money into your new employer and most of your employer sponsored savings is in the same place, then actually you might not need or want anything outside of what might be available through your employer. But if you have other savings, or if you really need kind of a different solution than is available, then you might be looking at it differently. So I think that everybody would really love for this entire process to be simplified because people don't necessarily know the right thing to do with all this money. Saving this money, whether it's just inside of your workplace plan or not, and they're not getting great guidance about what to do. And I really understand how confusing that is for folks. So, the idea of having a single place, at least to look at everything and make some kind of decision, that's really the gold standard. We're not there yet, but I'd say, hopefully people can get a lot of different needs addressed in one place. But if not, there are options.
So much like automatic enrollment and automatic escalation and target date funds really changed the game, this has the potential to truly change the game. As we wrap things up here, 3 tips from each of you. For somebody who's looking down the road at retirement, thinking, I do want to make this as easy as I possibly can on myself, and I'd like to worry a little bit less as well. Michael, what do you think?
Well, I think first of all, think a little bit about how much you need to spend in retirement. What's your budget going to look like? Is it $5,000 or $6,000 a month that you need to have to be able to cover your bills? let's start thinking ahead about a way to get to that number. So instead of thinking about savings, the lump sum aspect of investing, let's start thinking about lifestyle, the income part of investing. And if you've got a bunch of money sitting around in things like savings accounts or CDs right now, what is the purpose of that money? If the purpose of the money is lifetime income, then some kind of a deferred income annuity makes a lot of sense because you don't have to pay tax on the growth of that money. If you have it in CDs and you're earning, say, 5%, and you're in a 40% state and federal tax bracket, you're only earning 3% growth. So if you decide today that the purpose of the money is to provide a base of income, start thinking about ways of shepherding that along a little bit because you'll get the bonus of not having to pay taxes.
Fantastic. And Tamiko, from you, last thoughts?
Yeah, I mean, I would really think about, what is it that you're worried about? What kind of risks are you trying to take off the table? And, some of this is going to be replacing the income, but Michael had mentioned earlier too about automating that paycheck. And there's a real benefit to just knowing that that's going to be coming in. And particularly if, when you get older and you're not going to be able to manage a lot of the things that you're able to manage before you retire, this could make it much easier on yourself and other people that might be helping you. So think about that as well. It's really part of a holistic planning process.
Michael, Finke, Tamiko, Toland, thank you so much for joining us.
My pleasure. Great to be here.
Thank you.
If you're looking for more tools to help you better manage your money and grow your wealth, visit our website, the Alliance for Lifetime Income's website. And while you're there, be sure to subscribe to our newsletter. You'll find all of that at protectedincome.org and the newsletter at protectedincome.org/subscribe. Thanks so much for being here, everybody. We'll see you next time.